There's a structural gap forming in DeFi that most people aren't thinking about yet. Tokenized real-world assets are arriving on-chain in meaningful quantities. BlackRock's BUIDL fund, Franklin Templeton's BENJI, Ondo's OUSG. These aren't experiments or testnet proof of concepts. Institutional capital is actually moving into on-chain formats, and the pace is accelerating. The problem is that these assets are landing in an environment that wasn't built for them. Today, I want to map out what the missing piece is, and why the infrastructure question is more interesting than the asset arrival itself. In traditional finance, holding an asset doesn't mean locking up capital. A portfolio manager holding T-bills can use them as collateral for repo financing. An equity holder can write covered calls or buy protective puts. The infrastructure for productive capital management is assumed. It's just there, like water from a tap. On-chain, almost none of that infrastructure exists for tokenized assets. A holder of tokenized T-bills today has narrow options. Hold the asset passively and collect the yield. Sell it into stablecoins to access DeFi's existing derivative rails, or hope for native hedging tooling that hasn't been built yet. The second option defeats the point. Selling tokenized T-bills into USDC to open an interest rate hedge on a Perp exchange means you've exited the position you were trying to hedge. You've incurred fees, potential tax consequences, and now hold a stablecoin that doesn't replicate the T-bill's economics. You left the asset to access derivatives on the asset. That's backwards. What RWA holders need is derivative infrastructure that works around what they already hold, not a reason to liquidate it. The core requirement is actually deceptively simple. A Perp protocol that accepts non-stablecoin assets as collateral and can price them reliably. Most Perp exchanges avoid this entirely by requiring USDC. USDC pricing is trivial. No Oracle complexity, no collateral ratio calibration, no liquidation edge cases from collateral volatility. The trade-off is a permanent exclusion of every asset class that isn't already a dollar-denominated stablecoin. AnyCollateral is LeverUp's approach to this problem. Rather than requiring conversion to USDC, eligible assets can serve as margin directly. Each supported asset carries a collateral ratio, a discount to market value that accounts for price variability. If you deposit $100 worth of MON at a 70% collateral ratio, you have $70 of available margin. The collateral stays in its original form. The protocol manages the valuation risk at the protocol layer. The current collateral set covers monad ecosystem tokens, MON, LVMON, and LVUSD alongside USDC. But the design principles here, on-chain pricing, collateral ratio calibration, risk-managed acceptance criteria, are exactly the same principles that would apply to tokenized RWA assets as they qualify. The framework already exists. The question is which assets meet the bar. And that bar is real. I want to be direct about this. A collateral asset needs three things: on-chain liquidity deep enough to support orderly liquidation, price stability relative to the positions it's backing, and an on-chain price history sufficient to calibrate the collateral ratio conservatively. Many tokenized RWA assets today don't meet those criteria, not because they lack value as assets, but because their on-chain liquidity is thin relative to what a derivatives protocol needs to manage margin calls reliably. A tokenized T-bill with $10 million in on-chain liquidity creates real execution risk when a large position needs to be liquidated quickly. The bar is real, and it should be. Accepting assets that can't be priced and liquidated reliably creates systemic risk for every participant in the protocol. The value of any collateral is precisely that it doesn't lower the bar. It extends the framework to assets that clear it. As RWA assets mature on-chain, as liquidity deepens, secondary markets develop, price history accumulates, more of them will qualify. That trajectory is not speculative. It's already visible in the data. The infrastructure question is whether a derivatives protocol will be ready to accept them when they arrive. Monad's architecture makes it a natural landing zone for this. EVM compatibility means projects can deploy without rewriting their stack. Monad's throughput means the execution layer can actually process the volume that institutional capital and systematic strategies generate. And LeverUp's Oracle-referenced pricing through Pyth Pro means that as RWA assets come with on-chain price feeds, the execution layer already knows how to reference them. Let me zoom out to the broader pattern, because the RWA collateral case is one instance of something larger. As the on-chain asset universe grows, the value of a flexible collateral layer compounds. Every asset class that moves on-chain creates a new population of holders who want to do something productive with it beyond passive holding. Tokenized commodities create demand for hedging. Tokenized equities create demand for leveraged exposure. Tokenized credit instruments create demand for interest rate expressions. Each of these requires derivative infrastructure that accepts the underlying asset as collateral or can reference its price reliably. The alternative, a derivative ecosystem where every asset class must convert to USDC before accessing leverage, is a permanent tax on capital efficiency. It works when the asset universe is small. It breaks down as more asset classes arrive. The collateral layer is the choke point. Whoever builds it flexibly and robustly sets the terms for what productive on-chain capital management looks like. LeverUp is building that layer on Monad before the RWA demand fully arrives, not after. That timing matters. Infrastructure built to accommodate future assets is more useful than infrastructure retrofitted to accommodate them after they've already arrived, and the bottleneck has already been felt. The assets are on-chain. The derivatives layer is coming. The question is whether the collateral layer will be ready. For the AnyCollateral mechanics, how the collateral ratio works, how to deposit, how to monitor it, the AnyCollateral guide is in the show notes. And if you're a Monad ecosystem project interested in applying for collateral review, the link is AC, LeverUp, Zeiss. As always, this isn't financial advice. See you in the next one.